The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone, and thank you for joining us for today's webinar. Today we're going to be discussing the corporate tax expectations from the upcoming Indian Union budget. This budget will be presented in the backdrop of economic reforms such as demonetization of high denomination notes, rural agrarian challenges, the goods and services tax, and the expectations are really high. Our speaker for today is Chetan Daga. With over 8 years of experience in cross-border tax, Chetan is a part of transfer pricing and international tax practice at SKP. A chartered accountant by qualification, he actively works with multinational corporations on tax advisory matters and tax risk management projects. His corporate tax experience includes advising on India entry strategies, cross-border investment structuring, permanent establishment issues, and business tax requirements. He also assists multinational clients on M&A tax due diligence, BEPS risk assessment, and tax optimization matters. He has served clients across various sectors, including information technology, automotive, irrigation products, chemicals, pharmaceuticals, not-for-profits, and manufacturing. Welcome, Chetan. We are happy to have you host the webinar for all our listeners. Kindly note, all our listeners are in listen-only mode. If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address your queries at the end of the webinar. Without any further delay, we'll start the webinar. Over to you, Chetan.
Thank you, Pratik, and welcome to one and all for the webinar on budget expectations. Like every year, the union budget usually has a lot of hype, a lot of expectations from different stakeholders of the industry. One of the common expectations always has been, should the finance minister reduce my taxes? Should he make tax compliance easy? Should he make the tax law simple? Which are fairly common, and every year, what eventually turns out is something like this. While the expectations are simple, at times the implementation of the way the bill comes out is a little complex to comprehend. What we are going to be covering today is certain expectations from different sectors of the economy, which we believe are legitimate, and there is a fair chance that the finance minister would act on those. We're not going to be discussing about expectations which we ourselves know are difficult for the finance minister to fulfill. So to start with, first and foremost, yes, as we discussed, reduce the tax rates. Let's talk about the corporate tax side. So on the left-hand side of your screen, you would see a table with effective tax rates of some of the leading countries in the world. Certain countries have taxes lower than 20%. Many of them have taxes in the range of 20 to 25%. A case in point, the United States recently reduced its corporate tax rates by a massive 14%. So they reduced the tax rate from 35% to 21%. Compared to these countries, India's effective tax rate still stands at 34%, which makes Indian business really uncompetitive in the world. Also, a high tax rate prompts people to look at aggressive tax planning measures, and which results into a protracted round of litigation. So to start with, from the corporate tax side, the expectation is the finance minister should suitably reduce the corporate tax rate. In one of his earlier budgets, he himself had promised that he will bring down the tax rate to 25%. He's done so in bits and pieces. So for small and medium enterprises, the headline tax rate has been already brought down to 25%, and it is now expected that it should extend the benefit to the industry at large, including the large taxpayers. Secondly, when we talk about the effective tax rate, India has a multi-layer surcharge and education cess system. So when one talks about a 25% headline tax rate, it effectively translates into a 29% tax rate in the highest tax bracket. So an expectation is when the finance minister talks about reducing the tax rate to 25%, it has to be an all-inclusive reduction. No matter what level of surcharge and cess is applied, at the end of the day, my effective tax rate should come down to 25%. Third aspect is, India also has a minimum alternate tax, which is a tax on accounting profits. And typically a taxpayer pays the normal income tax or the minimum alternate tax, whichever is higher. Presently, the MAT effectively is at 20%. So any reduction in the corporate tax rate will not be effective unless the MAT is also correspondingly reduced. So that's the third expectation, that the MAT rate should also see a significant reduction. Also, the MAT started with a very low rate of 7.5%, but eventually over the years it kept on increasing, and today it is very close to the effective corporate tax rate. Lastly, the dividend distribution tax should also be reduced. The finance minister brought in a provision last year where dividends in excess of 10 lakh rupees are now taxable in the hands of individuals at the rate of 10%. So because the individuals are themselves paying tax on the dividends, the dividend distribution tax rate at least should be reduced so that the overall tax burden on corporate dividends is minimized. Moving to individual taxation, a topic which is very close at heart to all the listeners of the call. Here as well, the tax costs are disproportionately high. We have a 3-level slab rate system. The highest tax rate is 30%, which kicks in with a taxable income of 10 lakhs. And the limit of 10 lakhs is believed to be quite low. There is also a strong sense that a salary taxpayer and a self-employed taxpayer pay a very different level of taxes for the same level of income. While there could be multiple reasons for that, there is a strong case of providing equity between these two categories of taxpayers. India's tax base is also consistently low. We need to widen our tax base. More the number of taxpayers, more the tax revenue to the government, and which helps the government to reduce the tax rates across the board. Certain tax exemption limits, especially on the salaried side, are very low and archaic. To give you a few examples, we have a tax exemption for children education allowance. The limit is rupees 100 per child per month, and it is given for a maximum of 2 children. Now, clearly this limit does not keep pace with our changing times. There is also a tax exemption for meal expenses, which is restricted to rupees 50 per meal. In many places, one cannot have a proper breakfast at within 50 rupees per meal. So these limits should be looked at. Either they should be suitably enhanced, or they should simply be done away with to simplify the overall tax system. So from an individual tax side, whenever we talk about tax expectations, we get to hear, should the basic exemption be increased? So we have a basic exemption of 2.5 lakh rupees. Should it be increased, say 3 lakhs, 3.5 lakhs? In some cases, it's been represented that it should be increased to 5 lakhs. We believe the finance minister should not do so. And the reason I say this is, if one looks at the overall taxpayer base of India, out of the total population of about 125 crores, the number of taxpayers is only 3.7 crores. These are the tax return filers. Out of 3.7 crores, about 2 crores taxpayers report an income between 2.5 lakhs to 5 lakhs. And 1 crore taxpayers report income below 2.5 lakhs. Now, the moment you increase the basic exemption limit, at one stroke, a large number of taxpayers will move outside the tax net. Any which ways the tax base is very low, and plus, if the basic exemption is increased, more and more people will move out of the tax net, and the finance minister will be left with a very low base to tax. Also, the moment one goes below the basic exemption limit, there is an apprehension that the person may not actually file a tax return, and he goes out of the tracking system or the tracking mechanism of the government. So we believe basic exemption should not be increased, or should be increased only to adjust for inflation. At the same time, the individual taxpayer should be rewarded by giving deductions for certain direct expenses that he incurs. So certain examples we have put down here. Any expenditure incurred for skill development. So to give an example, where a salaried person attends a training say a 3-hour seminar or a 1-day seminar, he attends that to enhance his own skills, which also helps him in his employment. Those kind of expenses should be allowed as a tax reduction. Second, expenditure incurred for the benefit of dependent parents should also be tax deductible. There is a significant social and cultural angle to this aspect. Third is personal expenditure incurred through digital means. Is there a case to bring in a tax rebate there? So, to put it in terms of an example, today if a person goes out with his family to a restaurant and incurs a bill of 2,000 rupees, he really speaking has no incentive to carry a copy of that bill back home because he does not get a tax benefit out of it. But if a tax rebate is introduced even on the personal spending done through digital means, it would first promote digitalization. More and more payments will be done through digital means. And second, it would legitimize the spend done by a taxpayer. On the other side, it also tracks the income earned by the income earner. So a novel thought, but probably there is a case to incentivize personal expenditure through digital means. Lastly, expenditure incurred on creche. India has a sizable women working population. So typically when a lady resumes her official duties after her maternity leave, if she's putting the child in a creche, the expenditure incurred on the creche could also be considered as tax deductible. Apart from that, the tax slabs of 20% and 30% should be stretched. So a large portion of the income should be covered under the 20% slab rate, and only the high taxpayers or high income earners should suffer the 30% tax rate. The age limit for very senior citizens, which is currently 80 years, should be significantly reduced. There is a World Bank report which says that the life expectancy in India is about 68 years. So where an average Indian lives only for 68 years, there are going to be very, very few people who are going to be covered by the benefits given to the 80 plus year category. Also, the limits under section 80C should be increased, especially on the housing side. So any repayment of housing loan, at least for the first house, should be tax deductible in entirety. Today it is covered in the overall limit of 1.5 lakhs, which, especially for people living in the metros, a large portion of the housing loan repayment goes without any tax deduction. Also, healthcare premium, which is covered under section 80D, those limits should also be increased. And exemptions for allowances, what we discussed earlier, like medical allowance or children education allowance, they should also be suitably increased. Coming to certain simplification measures, these are like the low-hanging fruits. Certain small changes would result in a significant saving in taxpayers' compliances. So we put down a few examples here. First of all, surcharge and cess create confusion in understanding what's my effective tax rate. So we suggest, let's just do away with surcharge and cess. Let the government put up a flat rate. So whatever is the surcharge and cess amount, it could be built into the tax rate, but let's have a flat rate of tax. Second, the income tax law does not recognize the concept of materiality. And this becomes relevant where one distinguishes between capital expenditure and revenue expenditure. From an accounting perspective, assets of smaller value, it is okay to pass them off as expenses in the profit and loss statement. Of course, the scenario has now changed after the company law 2013. But from an income tax perspective, some concession should be given where assets of smaller value would be made eligible for 100% depreciation in the year of acquisition. Thirdly, tax residency certificate. Today, if you are making a payment to a non-resident and the non-resident wants to avail a tax treaty benefit, he needs to produce a tax residency certificate, which basically says that he is a tax resident of a particular country. While one can understand the necessity of a tax residency certificate, probably some limit should be introduced that for payments of smaller value, a TRC may not be required. Because obtaining TRC at times has some time and cost. So if there is a small one-time transaction, the foreign vendor may not really want to get a TRC, and the Indian payer effectively ends up bearing the cost of TDS. Moving forward, whenever a particular transaction is taxed at the tax treaty rates, there was a big confusion until a few years ago whether surcharge and cess applies on the tax treaty rates. A number of cases have been litigated. Courts have consistently held that the tax treaty rates are the final rates. You cannot apply surcharge and cess over and above the tax treaty rate. But it will help if the government accepts these court judgments and inserts a suitable amendment in the tax law itself. Lastly, effective 1st April 2016, the government introduced something called as Income Computation and Disclosure Standards. While the ICDS is a topic by itself, at a very broad level, what the ICDS meant was they were like accounting standards to calculate taxable income, of course with certain departures from the established accounting principles. The practical application of ICDS was, it was doing away with certain established accounting principles and certain settled principles derived from court judgments. The validity of ICDS was challenged before the Delhi High Court. The Delhi High Court, while it held that ICDS is valid, most of the provisions that were inconsistent with the court judgments, the High Court struck it down, saying that the government cannot try to overrule the court judgments without getting an amendment into the law. At the moment, there is a big confusion in terms of what do the taxpayers who are outside the jurisdiction of Delhi do, because you have a High Court judgment which says that ICDS, most of the provisions are not valid. So one expects that the government will come out with a specific position on where do they stand on ICDS, and naturally the expectation is that ICDS should be scrapped, because at the end of the day ICDS do not achieve any additional tax revenue to the government. Moving forward on the TDS side, TDS is often considered a very tedious and cumbersome activity. So we are dividing it into two parts, TDS on income and TDS on expenses. Starting with TDS on income, there is a particular section called Section 199 of the Income Tax Act. What it says is, you get credit for TDS in the year in which the relevant income is offered to tax. That is, income and TDS will always go hand in hand. On the other side, the Central Processing Center of the Tax Department, when it processes the tax returns, it looks at Form 26As. Now, Form 26As is nothing but compilation of information submitted by the tax deductors. So people who have deducted your tax, they will file their TDS returns, which will be reflected in your 26As. Now, naturally, there are inconsistencies between Section 199 and 26As. Simply because your tax deductor does not know in what year you have offered the income to tax. We have seen many cases where the payer has created a provision for expenditure and deducted tax in year 1. The income receiver has rendered services in year 2 and offered the income to tax in year 2. So this brings an inconsistency between the tax return and 26As, and a lot of time and effort eventually goes in reconciling the books with 26As. And this is a common question that the tax department also asks during scrutiny assessments. Just to simplify the whole thing, because at the end of the day, everything is a timing difference. If TDS has been deducted, I need to get a credit of it. The only question that remains is in which year. So to simplify the whole thing, an expectation is the government should give an option to the taxpayer. Either you should go by Section 199, that is income and TDS will go hand in hand, or he should be allowed to claim the TDS credit simply based on 26As. So the overall year-on-year reconciliation activity, both for the taxpayer as well as the tax department, can be avoided. On the expense side, there are different sections for depositing TDS. And there are cases where a taxpayer ends up depositing excess TDS under one particular code. Now, an excess TDS deposited, say in case of salaries, cannot be adjusted against non-salary payments. To a limited extent, the TDS utility has allowed use of credit for non-salaried vendors. So a TDS under 194C can be adjusted against 194J. But salary to non-salary or salary to non-resident, those kind of adjustments are not being allowed. Second, there is a significant issue going on in terms of whether TDS applies on month-end provisions. And a lot of companies create provisions at the end of the month for management reporting purpose, which are then reversed on the first of the next month. Strictly speaking, if one looks at the bare provisions of the law, TDS applies even on such month-end provisions. And certain matters have also been litigated before the courts. So that becomes practically difficult if one has to deduct TDS even on the provisions. Third is purchase of computer software. The definition of royalty under the domestic tax law covers all and sundry cases of software. So today, even if you buy a standard software product, you are liable to deduct TDS on it. A limited relief has been provided by way of a notification, but that notification does not apply to all the cases. So TDS on purchase of software then remains an issue. Fourth is reimbursements. So let's visualize a situation where you have a group entity outside of India. The group entity incurs an expenditure which the Indian entity reimburses. The question is whether on this reimbursement, whether TDS should be deducted, should not be deducted. One prevalent view that is coming from the courts is, had you made the payment to the third party directly, if you would have deducted TDS, then yes, on the reimbursement also TDS would be applicable. But at times, the tax authorities have also been taking a view that your group entity is incurring an expense which you are reimbursing. This still constitutes a technical or a managerial service rendered by your group to you, and therefore even a pure reimbursement should qualify for TDS, which creates a practical issue. Same is the case with cost sharing arrangements. Now, looking at all of this, and to simplify all these complications, first of all, the expectation is let the TDS be like a running account. The way you have for SENVAT credit, let it be a running account. So the TDS for any section can be adjusted against any section. Excess TDS deposited for 1 year can be carried forward. Second, for the provisions that are made during the year and reverse, TDS should not apply because they are nothing but provisions created for management reporting purpose. They do not create a right for the income earner to demand that income from you. Third, as far as software purchases are concerned, especially the standard software, it is nothing but a purchase of a copyrighted article. So it is like, you go to a bookstore and buy a book. Similarly, you go to a software vendor and buy a standard software. He is nothing but a trader of the software. So a standard software should be kept outside the purview of TDS. And some guidance should be provided that in what situations TDS would apply on reimbursements and cost-to-cost sharing arrangements. Certain examples of unwritten engagement. So let's look at this illustration. So this is a situation where Mr. A has sold certain shares of an unlisted company to Mr. B. The sale price was 100 rupees and the fair market value was 130 rupees. Now there is a particular provision, section 50CA, which says that if you are selling shares of an unlisted company at a price which is lower than the fair market value, then the fair market value will be considered as the sale consideration. So they will assume the fair market value as the actual sale consideration and the gain on that sale will be calculated accordingly. So where the actual sale consideration was 100 but the fair market value was 130, Mr. A will have to pay tax assuming the sale price is 130. The other way of looking at it is the difference between 130 and 100, that is 30 rupees, Mr. A will pay tax on it. Now when it goes to the buyer, that is Mr. B, there is another provision which says that if he has received shares, unlisted shares at a price lower than the fair market value, then Mr. B has benefited. Therefore, the difference between fair market value and the purchase price will also be taxed in the hands of Mr. B. Sum total, the same 30 rupees is being taxed in the hands of Mr. A as well as Mr. B, which is an unjust enrichment. It's a basic principle of tax law that the same income cannot be doubly taxed. So a legitimate expectation is either the seller should pay tax on such transactions or the buyer should pay, but definitely not both of them. Moving forward on the interest calculations. A taxpayer is supposed to pay advance tax. He is supposed to pay whatever is the balance of the tax by way of self-assessment. Now, if there is a shortfall in tax payment, the taxpayer pays interest to the government at the rate of 1% per month. But if the taxpayer has paid extra tax to the government, he gets a refund, but the interest rate on the refund is 0.5%. So when I pay less, I pay interest at 1% per month. But when I pay more, I get my money back at 0.5% per month. On top of it, the interest that I pay is not tax deductible, but the interest that I get on the refund is liable to tax. So we have certain expectations around this. First of all, it cannot be a case that my money is more valuable than your money. If the interest is compensatory, only to compensate the government for time value of money, then the interest payable on shortfall and the interest receivable on excess should be the same rate. Otherwise, the extra interest that I am paying on shortfall is nothing but an indirect penalty. So one expects that these two interest rates need to be rationalized. On the TDS side, wherever there is a delay in payment of TDS, there is an interest at 1 or 1.5% per month, as the case may be. But let's look at an example. A company deducted TDS on 30th September. The due date for payment, as we all know, was 7th of October. But the company paid it on 10th of October. So there was a delay of 10 days in paying TDS. The way the government system calculates interest in such cases is, it says 30th September to 30th September is 1 month. 1st October to 10th October is 1 month. So for the 10-day delay, the interest that is recovered is for 2 months, which purely from a commonsensical perspective sounds absurd, even though there are some technical arguments to support that calculation. But in the interest of fairness, the interest should be calculated on days basis, and for convenience purpose, probably days should be rounded off to 1 month. Moving ahead on tax incentives. The existing law has an incentive on employment generation. Given the overall thrust of the government and as well as the expectations from the industry players that the government should create more and more jobs. So there is this section called 80JJAA. It is an old section which the government revisited 2 years ago and sort of relaxed it. So the existing section says that, first of all, the benefit is given if you increase your headcount. There has to be an increase in employee over last year. And the benefit is available to all kinds of business. The benefit is, whatever is the increase in headcount, 30% of the salary paid to those people will be allowed as a deduction in the next 3 years. So you pay 100 rupees to the additional employee. You will get deduction for the 100 plus in the first, second and third year, you get a deduction of 30, 30 and 30. So over a period of 3 years, you pay 100, you get a deduction of 190. There are certain conditions attached to claiming this benefit. And that's where the issue lies, because some of the conditions are very stringent. So first condition is, the employee should work for a minimum period of 240 days during the financial year. So which roughly translates into 8 months. The problem with this condition is, any employee who joins an organization after the month of July cannot really satisfy the 240-day criteria, and therefore such employees go out of the net of this incentive. So the incentive is only restricted to employees hired only between April to July. Now, as we all know, business strategies would not always provide for hiring only for April to July. A business would hire as and when it needs employees. So that is one condition which we expect that it should be relaxed, or it should even be done away with. Second is, even if you satisfy the 240-day criteria, the incentive is available only for those employees whose salary is up to 25,000 per month, which is 3 lakh per year. Again, in today's day and age, a 3 lakh per year salary is not a very large amount, and many legitimate employees who satisfy the 240-day criteria, but purely because the salary is more than 25,000, the company is not eligible for the incentive. So the expectation is that the 25,000 limit should also be suitably enhanced. More importantly, there is one lacuna in the existing provision. It does not provide for continuity of employment. So I take up an employee, satisfy the 240-day criteria. satisfy the 25,000 per month criteria, but there is no requirement that the person should be employed with the organization say for 2 years or 3 years. So even if the person leaves the organization 1 year later, the company still gets the benefit of 3 years. So to prevent any aggressive tax planning around this, condition should be inserted that the person is employed with the company for a fairly reasonable period of time. Apart from this, there are certain sectors specific incentives that are needed. First is the scientific research expenditure. We already have R&D tax credits. There are weighted deductions for scientific research expenditure, which are now set to expire. It is expected that these benefits should be continued at least for the next 3 to 5 years. Second is the government should incentivize setting up highway trauma and accident centers. Now there are some disturbing statistics here. As per the government's official records, in the year 2016, there were 4,86,000 road accidents in India. And these are only the highway accidents. They do not cover the accidents that take place on city roads. There is another report which says there is one death every 4 minutes in highway accidents in India. 22% of the road accident victims are children below the age of 16 years. And in many cases, from the place of the accident, the closest trauma or medical care center is more than 50 kilometers. So there is a strong social need to incentivize setting up of highway accident and trauma centers. It is expensive to set up these centers, probably for remote highways, and that's one of the primary reasons that at least a tax incentive should be provided. Same is the case with rural purification and supply, water purification and supply projects. There is a survey that was done by the Indian Human Development Organization, which said that out of the total rural households in India, 25% of the households, they have to walk every day for 30 minutes only to get access to drinking water. And that is a case in itself to provide at least a tax incentive for water purification and supply. Same is the case with sanitation. While the government is very active and very aggressive in terms of setting up toilets in rural areas, still 40% of the rural population does not have access to toilets. And the more astonishing fact is, if one goes by the rural population, they have more access to mobile phones than toilets. Therefore, there is a case of introducing private partnership in sanitation projects and incentivize the participants by way of a tax incentive. Lastly, tourism. Tourism is considered as one area which has abundant potential for India, along with allied sectors like aviation and hospitality. More than 50 countries have their tourism boards operating in India, which promote tourism from India to those countries. India being such a large country where each of our states are equal to the size of a country, probably in Europe, India does not have a national tourism board itself. So this is one sector which has abundant untapped potential, which the government should actively look at. Coming to some special provisions on the corporate tax side, one is migration to a limited liability partnership. Limited liability partnership as an instrument, as a vehicle, was introduced in 2008, and for foreign investors, the regime was initially a little stringent, but it was relaxed in 2014 and 2016. A limited liability partnership gives flexibility, combines the best aspects of a partnership form and a company, and that's why a lot of existing companies want to move to a LLP structure. But there are certain obstacles in the law. If you want to convert an existing company into an LLP, the conversion will be tax neutral if certain conditions are satisfied. And again, the conditions here are difficult to satisfy. So some of the conditions are: the company's turnover for any of the last 3 years should not exceed 60 lakh rupees. Now the limit of 60 lakhs is extremely low. We expect that at least that limit should be increased. Second, the assets of the company in any of the last 3 years should not exceed 5 crores. So these two limits of 60 lakhs and 5 crores, because they are very low, most of the existing companies do not satisfy, and they are therefore little afraid of moving to an LLP structure, with this background, it is expected, at least first and foremost, if an existing company is converting into LLP, the conversion should be tax neutral. Because really speaking, nothing changes. You take the cloak of a company away and you put a cloak of a company. If at all it has to be taxed, the limits of 60 lakhs and 5 crore should be suitably increased. Coming to indirect transfer of shares, this is also commonly known as the Vodafone Amendment. So I'll explain this by way of an example. If viewers can focus on the diagram on the right hand side. So there is a company outside India, company F. This company holds shares in an Indian company, company I. The shareholders of company F are also outside India. They sell the shares of F to a buyer outside India. So sum and substance, seller is outside India, buyer is outside India. What is being bought and sold, that is shares of F, those shares are also outside India. So everything is happening outside India. But because of this transaction, the control of I, which is an Indian company, is being passed from the seller to the buyer. This is what the indirect transfer provision seeks to address. Sum and substance, what it says is, if there is a transfer of shares between two non-residents and the shares are of a foreign company, the transaction will still attract tax in India if company F derives substantial value from company I. So where, let's say company F is a dummy company, it's nothing but like a holding company, then the transaction will attract tax in India. And what is substantial value? The value has to be at least 100 million, that is, and 50% of the value of F should be derived from company I. So the implication one can understand where there is a transfer between two unrelated parties. But many a times, companies simply want to align the structure at a group level where the shares are being transferred from one company of the group to another company of the group. The idea is only to realign the shareholding structure and not to liquidate the Indian investor. So it is expected that where the ultimate ownership of company I remains same and there is only an intra-group transfer, such intra-group transfer should be outside the purview of indirect transfer regulations. Now, Section 79 applies only in case of loss-making companies. And Section 79 basically says that if you are a closely held company and there is a change in shareholding by more than 49%, then whatever losses have been brought forward, they will lapse, they will not be allowed to be carried forward. You can carry forward unabsorbed depreciation, but the business loss will lapse. So if you look at the illustration, company A holds 100% in B and B holds 100% in C. And let us say that C has substantial brought forward losses. Now again, as a part of the group restructuring, company B sells shares of company C to A. So the amended structure is, while A still remains the ultimate owner, it directly holds shares in B and directly holds shares in C. Now, really speaking, the voting power has not changed because company A has been the ultimate holding company in both the structures. But the way the provision reads is, even in such cases, from company C's perspective, the shareholders have changed. The old shareholders were B and the new shareholders are A. So in such cases, the losses, brought forward losses will lapse. So we expect that Section 79 should not again be applied in an intra-group transfer of shares. And coming to some macroeconomic aspects. First of all, as we briefly discussed while we were discussing individual taxation, India's tax base is quite narrow. Only 1.7% of the total population pays income tax. So the taxpayers are really a minority portion of the overall population. Second, the government is talking about jurisdiction-free assessments. So today, if a person is in Mumbai, the income tax assessment happens in Mumbai. If the person is in Bangalore, it happens in Bangalore. The government is looking at a jurisdiction-free assessment where, first of all, the proceedings would be electronic. And wherever the tax department has surplus bandwidth available, the officer at that location would handle your case. So you may be in Mumbai, but an officer in Patna may be handling the case. And because the entire proceeding is electronic, there is no necessity for you to travel to Patna or for him to call you to his office. So this is something which is there on the cards. Rising popularity of cryptocurrencies. All of us must be hearing about cryptocurrencies like Bitcoin, Ethereum, Ripple, and there are a lot of discussions happening around how does a cryptocurrency operate and should it be regulated. The government of India has issued a few warnings saying that cryptocurrencies are nothing but Ponzi schemes. They are unregulated, and investors doing transactions in cryptocurrencies are doing it at their own risk. So they warned the investors, but they have stopped short of banning transactions in cryptocurrencies. On the tax side, a question of course remains the income from cryptocurrencies, how it will be taxed. Will it be business income? Will it be capital gains? If it is business income, whether it will be normal business income or it will be a speculative business income. So one expects that the tax treatment of cryptocurrency should be clarified. Also, the government's approach at a policy level on investments in cryptocurrency should also be clarified. That whether the government is okay to allow transactions in cryptocurrencies, the government is not okay, or it is left to the personal risk of the investors, those aspects need to be clarified. Like every budget, there is a call of levying tax on long-term capital gains on sale of listed equity shares. As we all know, listed equity shares held for more than 12 months. Any gain arising on the sale of such shares is free from tax. The case in support of levying tax on long-term capital gains is the stock market now is pretty broad-based. We are seeing more and more participation from people into the financial markets, and therefore the market can handle any incidence of tax that will be imposed. We expect the government should not levy a tax on long-term capital gains. Given the fall in interest rates, the financial markets is one of the primary avenues of investments for a lot of people. The economy has revived. We have seen increased number of IPOs, as well as industrial production is picking up. So any tinkering with the financial markets at this stage may have an adverse impact on the emerging sectors of the economy, as well as the revival of the economy as a whole. At best, what the finance minister could possibly do is to qualify as long-term capital asset, the holding period, which is today 1 year, this could be extended to 2 years. This will also bring listed securities at par with unlisted securities as well as real estate. So that possibility is there, but we believe there should not be a tax on long-term capital gains as yet. The Ind AS are now becoming applicable to a large number of companies, but there is no guidance available in the Income Tax Act as far as the normal tax provisions are concerned on how does one go about calculating the taxable income. Guidance has been provided under the minimum alternate tax, but not under the normal tax provisions. So the government should probably bring up a schedule to provide for certain adjustments for companies drawing up books on Ind AS. There has been a lot of discussion around the calendar year being considered as the new financial year. And in the run-up to this webinar, we got a number of queries from participants. Like, what does one expect on the government moving to the calendar year? Well, we believe at least this will not happen in the short run. There's been a lot of disruption in economy at large and the businesses in general because of GST and demonetization. The government would provide and is likely to consider the needs of business and provide a breather when not changing the financial year immediately. Because again, this change cannot happen in Income Tax Act in isolation. A lot of other laws will have to be amended. There is also talk of a new direct tax code. The government recently constituted an expert committee to look at the existing tax law and make suggestions to it. The committee has 6 months to submit the report, which will be somewhere around May or June of 2018. So at least for the next 2 years, the new direct tax code does not look likely. So we don't have much to worry about on the change of calendar year as well as the new direct tax code. And To sum it up, one also expects that the government should show up or should clarify its roadmap of how the tax system is going to function in the next few years. A lot of questions have also been asked that post demonetization, it was expected that the government would go after tax evaders, but not much action is happening. And this is a perception. The government on its side presents certain data, certain statistics in terms of the number of inquiries they have made, number of notices they have sent, number of assets that they have attached. It is from this perspective that an honest taxpayer expects that you tax the tax defaulters and you reward the honest taxpayer. With this background, it is now expected that the government should lay down the roadmap. This is the last budget of the present term of the Modi government. So it is expected to be populist, but the Prime Minister himself in certain recent TV interviews has clarified that they are not really looking in for a populist budget. They are looking at development of the economy from a long-term perspective, so there may not be adequate tax shops in the budget. Having said that, the government has done precious little for the individual taxpayers in the last 3 years. At least that's the perception. So at least some degree of tax saving would definitely kick in. To what extent the finance minister goes, whether he has the resources to do that, where does he get the money from to provide tax largesse? These are the questions. Thankfully, we do not have to answer. It is something that the finance minister has to answer on the 1st of February. So all of us are tuned to 11 a.m. on 1st of February, where the finance minister rises to present his budget. So this brings us to the conclusion of this webinar. And if you all have any questions, I'll be more than happy to address those.
Thank you so much, Chetan, for those valuable insights. We have a couple of questions for you from our viewers. The first one being, should the government abolish the dividend distribution tax?
Okay. Long and short of it, no, it should not. The reason being, the dividend distribution tax provides a lot of administrative convenience to the government. Instead of going to the individual shareholders and taxing them, it is a lot more convenient to collect the tax at the company level. However, yes, there is a case to reduce the dividend distribution tax rate down, and this is something which we expect the government to at least address in the upcoming past.
Okay, we have another question. This is from Amira. She says, I read about the government launching prosecution for people who have not paid TDS. Was this a one-off case?
Okay, definitely not a one-off case. The government is very actively looking at people who have deducted TDS but not deposited. Of course, they are going after the habitual offenders. So people who have consistently delayed depositing the TDS, a lot of prosecution notices have been issued. We've handled quite a few matters at SKP where we've seen companies getting these notices. One important aspect to mention here is a lot of taxpayers are under the belief that even if I have deposited the TDS late, I have paid the applicable interest and therefore there is no loss to the government. Well, folks, this is an argument which the government is not entertaining. The tax department is taking a view that payment of interest any which was mandatory. What they are looking at is enforcing the compliance. So they are definitely going after habitual offenders who are consistently deducting TDS but depositing them late. So definitely not a one-off case for sure.
Okay, I urge all our viewers to put in any questions you have for our presenter right now. We have one more question from Apurva. Apurva asks, are there any expectations on ICDS clarifications?
Definitely yes. There has been a lot of criticism on ICDS ever since they came in. But the government has been very adamant about it. They are very strong-willed. They definitely want the ICDS to come in. The confusion has been created by the Delhi High Court judgment, where the High Court said that ICDS have come in by way of a notification, which has been issued by the CBDT. So the High Court said the CBDT does not have the power to overrule certain judgments of the courts. That power lies only with the Parliament. So two possible approaches is, one, whatever ICDS provisions the government wants to persist with, they may pick them up and make them a part of the law itself. So then, the question of challenging before the courts would not arise. Or they may scrap ICDS altogether, saying that they would go by the Delhi High Court judgment. But if they scrap ICDS, then it gives rise to an interesting situation. For financial year 16-17, a lot of people have computed their taxes by applying ICDS. So what happens to those cases? Because if I have added something to my taxable income in 16-17, I would be claiming a corresponding deduction either in financial year 17-18 or 18-19 again under ICDS provisions. So if you scrap ICDS for 17-18, whether I will still be able to claim that deduction. So there are multiple variables one needs to look at. But yes, we would hope that the ICDS is scrapped because it's a nightmare to do that in plans.
Okay, I don't see any more questions coming in from our viewers. So with that, we'll wind up the webinar. Thank you, Chetan, for taking the time to share insights on the upcoming union budget with us. And I'm sure that your perspective has been valuable to all our viewers. To all our viewers at home and around the country and the world, please feel free to write to us at skp.tax@skpgroup.com. I repeat, skp.tax@skpgroup.com. If you have any questions or doubts on this topic, we will be happy to assist you with your queries. For Chetan Daga, and I thank all of you for joining once again, and we will see you next time.